tests. Now, some of you do better on multiple choice tests, some of you do better on problem type tests. So this, your next test will be problems, and your last test will be multiple choice. That's your exam. Let me give you a Scantron to you first. And like I say, some of these were not good, some of them were great. There's one like that there. Dave's is on here. There. On good. Okay. Arthur. Ringo. Eva. All those guys made over. Mike. You don't like those two. Christopher. Mike. Jessica. Robert Brown's one here. Carlos. And there's no here. Right here. Save this one. Everybody got their test. Just a lot of people not here. I'm gonna give you a test to look at and learn, maybe read. Now these tests have names on them, but it doesn't matter. So I'm not going to hand them out by name. I'm just going to hand them out at random. Doesn't matter whose test you've got. Don't have answers on them anyway. Oh, Alexander, you had answers all over yours, so I'll give you yours then. Okay, let's look at the first page, 1 through 6. All right. Let's look at these real quick and answer. A disadvantage of the corporate form of business entity is C. Corporations are subject to more government regulations. The excessive issue price over par of common stock is termed. That should be what? D, a premium. Now, some of these you should have got just from working problems. Alma Corporation issues 1,000 shares of $10 par common at $16 a share. When the transaction is recorded, credits are made to, and that answer should be B, common stock, $10,000, and paid in capital, $6,000. Debit cash for $16,000. The charter of corporation provides for the issuance of 100,000 shares of common. Assume 60,000 shares were originally issued and 5 were subsequently reacquired. That means you have 55,000 shares issued and outstanding. So number 4, the answer would be D. $1 a share, of course. What is the amount of cash dividend to be paid? You only pay it on that issued and outstanding. 5, the cumulative effect of declaration payment of cash dividend on a company's financial statements is 2. Number 5, your answer is D, decrease total assets and and stockholders' equity. You pay a cash dividend, that ends up coming out of retained earnings, and you pay it with cash, so that comes out of assets. So D is your only answer. 6, the liability for dividends recorded on which of the following dates? Date of record, date of payment, date of announcement, date of declaration. That'd be D, the date of declaration. Any questions? 1 through 6. Robert.
On number 2, I had erased number C, I put D. I guess I didn't erase it enough to.
Wait a minute. Now, number 2, you had what?
I put D. But I put C at first and erased C.
Oh, it picked up C, didn't it?
Yeah.
Okay, let's see. These were, what was on this thing? 40? Right now, put a +2.5.
My test didn't have the last page. I
What?
only had up to 37.
Well, you missed 3 then, didn't you?
Yeah.
What are those 3?
Last 3, yes.
I just realized that. Because I looked at the back page and I don't even remember.
Yeah, you don't even
saying
have an
that.
answer on
No.
38, 39, 40. Oh, Jessica, I don't know what we can do about that.
Yeah, she's found yours. Just like flip a coin.
See,
That's the issue
He
with.
has my paper. I don't have the last page.
Yeah, it ends up 37. And the second page isn't even stapled in.
No.
What can I get that?
Well, what happened? Moving on, 7 through 13.
Might this be counted out of 37 then?
We'll see. That's a little bit, Jessica. I don't know. Come in, guys. Gotta be late. First day by.
Everybody's in the, right?
All right. No, your bus didn't run?
No, that's good.
We all just like to come in late so everybody can see. Well, I saw one of the other ladies here, she came in real ugly downstairs. Where she be? It's really, maybe a little, but.
I mean, I don't think, but I know I didn't.
I walked down
That
the
page.
No matter what name it is, we're just looking at them.
Oh, I got
Okay, number 7, when a stock dividend is declared, which of the following account is credited? When a stock dividend is declared, that would be C, stock dividends distributable. Franco, hold on a minute. Franco, get your test. I'm not walking back there again. Hold on, let me give you one to look at. Don't matter what name's on it.
Thank you.
Okay, now we need the Serbian presence. All right, number 8, treasury stock shares are. Number 8, the answer is D as in dog. Number 9, how is treasury stock shown on the balance sheet? The answer is B as in boy, as a decrease in stockholders' equity. That's the last subtraction you make. The excessive sales price of treasury stock over the cost should be credited to. Paid in capital from the sale of treasury stock. C. 11, treasury stock which was purchased for 3 is sold for 35. As a result of these two transactions combined, on number 11, the answer is C. Stockholders' equity will increase by 500. I paid 3 for it. So 35, you had a gain of 5, and that's all that increases. 12, which of the following amounts should be disclosed in the stockholders' equity section of the balance sheet? Number 12, the answer is D, all. The number of shares of common outstanding, the number of shares of common stock issued, the number of shares of stock authorized. And 13, retained earnings. The answer is C, changes are summarized in the retained earnings statement. Any questions on 7 through 13?
I had C, but mine read it as A.
Did you erase?
Yeah.
Put a plus 2.5. It's good to review these because what is the total stockholders' equity based on the following data? Number 14, the answer will be C, which is 835,000. I think you only had to add them together. 510 plus 375 minus 50. Retained earnings deficit is not like having a loss. 15, when a corporation has a 3-for-1 split, your answer would be D, B and C above. The market price of the stock is decreased, the par value per share is decreased. Both things will happen. Number 16, the primary purpose of a stock split is. Number 16, your answer is B. All right, reduce the market price of the stock per share. A corporation has 60,000 shares of $25 par stock outstanding and has a current market value of $120 a share. If the corporation issues a 5-for-1 stock split, the number of shares outstanding will be. All right, that should be easy enough. 5 times 6 is what? 17 BC. Earnings per share, number 18. Answer is D as in dog. Helps compare companies of different sizes and of common interest.
Hello.
Joe finally decided, hold it, get the test. I'm not gonna walk back there again. All right,
That's me.
that's you. And this is you. Just a minute, let me give you a test.
Okay.
Hold on. It doesn't matter what name. Okay, now we'll get everybody here but Robert Brown and Amber Ball. Amber Ball is a live streamer, and then we're gonna have Jacob. All right, I think we were on number 18, which is D as in dog. Earnings per share is the net income per column must be reported by publicly traded companies, helps compare companies different sizes. Number 18, what did I take? The answer is D as in dog. Number 19, Samuels reported net income of 305 during 2011, using the whole year here. They had 5,000 shares, $100 par, 5,000 preferred, and 20,000 of $5 par common. Samuel's earnings per share is. And number 19, the answer is A, $4. How you get earnings per share? You take the income minus preferred dividends divided by the number of common shares. 20, one potential advantage of financing corporations through the use of bonds rather than common stock is, and 20, the answer is C, the interest expense is deductible for tax purposes. I think I repeated that more than once. Any questions on number 14 through 20? Anybody else have an eraser that, what, do you have another eraser, Robert?
18.
You had the right answer?
Yeah, excellent. Good. A.
Put a plus 2.5. Number 21 through 6. The interest rate specified in the bond indenture is called the contract rate B. On January, we issued 10% bonds with a face value of 200,000. The bonds are sold for 196. All right, that's a discount of 4. The bonds pay interest 2 times a year. Horton records straight line amortization. The bond interest expense for the year is. All right, for the year, they record interest in June and December, same year. So what is 10% of 200,000? That's 20,000. And what is 4,000 divided by how many years were these bonds? How many years were the bonds, did it say?
It didn't say.
Huh?
It didn't.
Well, how can you do straight line interest if it don't
Maturity
say?
date is December 31st, 2014, so 4 years.
Oh, okay. 4 years? That'd be 8 periods. 8 periods into 4,000. That won't work. 8 periods into 4,000 would be fine, wouldn't it? Let's see, we sold them on 10, so 10, 11, 12, 13, 14, 5 years. So 10 into 4,000 would be 400. And for the year it'd be 800. So your answer would have to be C, 20,800. 23, a corporation issues $1 million 20-year bonds, interest payable at a time when the market rate is 12. So the market's paying 12, we're only paying 10. We're gonna sell them at a discount. Did I give, well, here it didn't matter. 23, the answer is C. Amount of unamortized discount decreases on its balance at issuance date to a zero balance at maturity. 24, the straight line method of amortization bonds discount is used. Which of the following things happen? Number 24 would be B. Annual interest will remain the same over the life of the bonds with the amortization of bond discount. That was a tough one. 25, the adjusted entry to record the amortization of a discount is. Number 25 would be B. Debit interest expense and credit discount. And 26, the market rate. 25, B as in boy. What Scantron didn't like you, it's never seen you. But add 2.5 back, yeah. That's why we're going over this one thing. It'll cheat somebody out 2.5 to 5 points. Let some people know that 37 is a strange number to have on a test, and they should have passed.
Yes, it is.
It's a strange number, Jessica. You should have asked that.
I questioned it, but I was just thinking that you were just like, let's make it a weird number.
I would go 33 or 40 or 25. Even 30, I could go 3 or 30 piece. But anyway,
Look,
number
I had a
26.
concussion. I wasn't thinking straight anyway.
Number 26, did I give you an amount on that? 26, the answer ended up being B, $896.
I put B and it counted it wrong.
Okay, put a plus 2.5. Did you erase?
Yeah.
When you erase, it's hard to get into it, not pick up the one you
Yeah,
erase.
and I even erased it, like, until it was barely
Yeah.
seeable.
$27, the journal entry a company records for the payment of interest, expense, amortization is. Was there any other question on up to 26? All right. 27, your answer will be A. Debit interest expense, credit cash, and credit discount. So you still have to know your term of interest. You have to know your straight line. I didn't give you the interest methods. corporation issues 100,000, 10% 5-year bond. Now, your question is, amount of bond interest expense to be recognized is number 28. The answer would have been D, 4,580. So that's some of that premium decreasing your real interest expense. I stated that a few times. All right, 30, the American Corporation issued 1,000 10-year 8% 1,000 bond at 96. Journal entry report issuance will show A. Number 30, I think the answer is A. A debit to discount bonds payable for 40,000. Remember, $1,000 bond. That's a million. Your discount is 4%. 4% of a million is 40,000. 31. Bonds with a face value of $1 million are sold at 98. That's 2%. Entry recorded issuance is 2% of $1 million is 20,000. So what do we have to debit here? Number 31, that you should probably see. Debit cash, debit discount, credit bonds payable. Now, number 32, I don't think I ever mentioned that to you. It was in your book. A sinking fund investment will be classified on balance sheet. Now, bond sinking fund is you put money aside every year to pay off of those bonds. If it's a 20-year bond, you can't come up with 10 million or whatever in that year. You put a little aside every year, and it goes into a sinking fund. So 32, your answer is C. It's an investment. Question on that page. $33. All right. Jessica and Morgan were both sick during the break. Anybody else get sick during the break? You get the flu?
Not the flu, but I did get a bad nasty stomach bug.
Did you get sick, Millie? Did you get the flu? Well, I'm glad you saved the break to get sick. All right. Number 33, the bonds payable are not callable for the issuing corporation. If bonds payable are not callable. Number 33, the answer is B as in boy. 34, when callable bonds are redeemed below carrying value. 34, I think the answer is A. Gain on redemption of bonds is credit. Gain is credit, losses are debit. Number 35, bonds payable has a balance of $1 million. Discount is 15. The issuing corporation redeems bond 97.5. What is the amount of gain or loss? Multiply $1 million times 97.5. And factor in your 15,000. Your answer is number 35. D. $10,000 gain. The balance and discount on bonds payable, number 36, that should be D, would be subtracted from the related bonds payable on the balance sheet. We never practice that balance sheet. 37, debtors are interested in times interest earned ratio because they want to what? Number 37, B, have adequate protection against a potential drop in earnings jeopardizing their interest payment. This is where your test ends, Jessica. All right, but the last three questions were good ones. Number 38, balance sheet and income statement items are given. Based on the data above, what is the number of times interest earned? You could have had that formula written down. Number 38, the answer I think is D, as in board. 4.33. Balance sheet income information is given. Again, do the times interest earned. Probably if you missed 38, you missed 39. But 39, I think the answer is C. No, it's A. 5.72. And 40. If a company borrows money from a bank as an installment note, I didn't give you that note amortization. without giving you problems, there's so much I couldn't give you. But anyway, 40 is A equals the interest rate on the note times the carried amount of the note at the beginning of the period. Okay, now, I haven't recorded these yet, and I think everybody added their bonuses in where they should have. And some of you are adding 2.5 points, and Robert's case probably 5. Test in your case, take your calculator. All right, how many did you miss?
About 20,
How many right?
29 out of 37.
29. Okay, how we gonna do this? Turn that 29. Divide that by 40, see what you get.
About 40.
Yeah, try it. What?
70.
All right. Oh, no, divide it by 37, I'm sorry.
Okay.
37. That got you right back where you were.
78.
78. Okay. Right, jelly bonuses.
Plus 5.
Right, take the 78 plus 5. Okay, is everybody good on your bonuses, on your 2.5s? All right. With the bonus, everything considered, how many people now made 100 or above? 3. Arthur, did you make 100 or above? Arthur, what'd you make with the bid? Okay. All right. 5 people made 100 or above. But there's a lot of A's on this test. I'm disappointed 2 or 3 people went down on this test. Now, I turned in only about 4 bad midterm grades. Probably if you did good on the first test and bad on this one, I didn't turn in a bad midterm grade. You did bad on the first one and good on this one, I didn't turn in a bad midterm grade. Depending on how the next 2 tests go, I know SIGGA's breaks your grade up if you do that. Now 4 tests, I hate to drop one, but you know, depends on how we do in the next 2 tests, whether I'll drop a test grade or not. Okay, don't count on it. All right, let me take the test and the grade form. Just let me take the green forms. If you would, pass those white tests to the front. On both sides, just pass those white tests to the front. That'll save you a minute. You all like most of the 4 tests, right? You all like most of the 4 tests? Right? Now, passing the white test toward the front. Guys, don't pass the white test toward the front. Pass your white test up to the next table. Now, this side over here had no trouble passing up all the white tests. Is this side over here still having trouble passing up white tests? They did. Okay, that's 2 down. That's midterm gone. We've got the second term of this semester to do what we can do. We've got 6 chapters to cover. Now, we covered two hard chapters on corporations. And some of you made good grades on the multiple choice test. But now we're going to start another chapter. It's not easy. But I think after chapter 15, the chapters get easier because they stand alone on ratios or cash flow or managerial accounting. But this next chapter is still corporations. But it's corporations invested in other corporations. Now, we had one chapter, financing a corporation with stock. We had another chapter, financing a corporation with bonds. Now we've got a chapter where a corporation invests in other companies. So let's look at some PowerPoint. Right? Investments, as corporations invest in other companies, you always can read the objectives. But if a corporation has excess money, they may want to buy another corporation. And we know a lot of our big American corporations own subsidiaries. And, like General Motors, they may own pretty much most of the stock in some companies that supply, maybe their radios or their spark plugs or whatever. So different companies have different subsidiaries and ownership. So that's what we need to look at in this chapter is ownership. Cash may be used, we know what cash is used for, but we can use it for investing, of course. Now, instead of letting excess cash remain idle, we'll invest it. Debt securities, which are notes and bonds. We buy bonds. When we get interest on bonds, what do you think the interest will be called if we get interest on our bonds that we own? Bonds that we owed, we had interest expense. So bonds that we own, we'll have interest what? Income. Or interest receivable in an adjusted income. All right, stock, which are preferred and common stock that represent ownership. Investments in debt securities is called investments. So now we're going to debit debt securities, or we're going to debit investments and credit cash when we buy these items. Now, if we have stock, we pay dividends, right? If we own stock, we receive dividends. So in chapter 13, it was dividends payable, right? Now it may be dividends receivable or dividend income. Dividend revenue. All right, investments in certificates of deposits and other securities that do not normally change in value are disclosed in the balance sheet as cash or cash equivalents. If you got a CD or a checking account or a savings account, those are cash or cash equivalents. Same as coins and dollars, 10s and 20s. Millie, don't one of you ladies have any money from your country? But the penny? Right now, what country have the salt currency of the euro? How much is that worth?
10 cents.
You see the knife? Is that the container? Oh, okay.
You go like this a little bit. That's
What is this? It says 200, 240. We're not in France, the euro, painted Argentina. We use peso like Mexico. Peso, European money, all right. This is 2 cents. So how much this was worth?
what is it? That's
It says 20. Pass these back. This is Serbia, not euro. Serbia, 20 cents and 2 cents. You what?
Dinner, like dinner, but with egg.
Now, what would that 20-cent piece be worth in this country? 2 cents?
It's not.
Not much?
100 those for the ones.
When 100 2-cent pieces would be worth $1.
So just 100 cents. So this is 20, so we need like 5.
That's just currency exchange and different value. We should have a course in international accounting. A lot of countries do accounting a little bit different, but we could have a class in this country, which we do in some universities, international accounting, how we do the currency exchanges. And
We don't need that.
if I had accounts receivable from Serbia, I'd have to convert their currency to ours. Now, time I collected that account receivable, I may have a gain or loss on that currency. It could have went up or down time I collected. So that would be international accounting.
It's like we have credit card, my parents put the money there in our currency, but I can use it here and then do it over.
Or your same credit card, you can use it here.
Yeah. I don't know.
Also, our country, we use two currencies our whole life.
You use euro
Yeah, sometimes.
in Serbia.
Yeah, so everywhere you can find exchange shops, everywhere. You have three in one street, usually where I live. And since you're a child, you're learning about exchange.
No, I understood it. I think she was in Taiwan. She said it would take a truck of big truck load of dark cash, pay her tuition. Once they was converted. But it's interesting. And a lot of people invest in currency to get profits and losses. They'll invest in foreign currencies, the same as they may invest in gold or silver, stock or bonds, or commodities such as soybeans or corn or pork milk. Okay. Does anybody have any relatives out in Nebraska? I've got a sister out there in a little town called Wahoo.
Nebraska,
Yeah.
it's flooding over there right now.
You know, it flooded her town. She was like on an island after the water came. It's flat, the water don't have a lot of places to go. They have a lot of rivers and creeks. But to drive to the grocery store, she had to drive 60 miles instead of 30 because of the water. On one little town near them, it's completely isolated by water. Now, the water's only about a foot deep, so you can't get a boat in. The roads have sank, something, I guess, and broken up, and the bridges have fallen because the ground got so soft. So they had to fly food into that little town because it was isolated. farmers' cows, calves are getting drowned. One farmer lost 100 newborn calves in the flood. And Nebraska raises a lot of corn, wheat, and soy, and when they see those prices go up for corn products, they can't get their fields straightened out in time to have their crops. So one state disaster hurts other states when it comes to goods, okay? All right, if we invest in temporary investments, we want to earn some interest. We want to earn some dividends. We want to realize gains when we sell our stock. We want the price to go up. Right? When you purchase bonds, you debit investment account, credit cash, and there may be a brokerage commission as a fee charged by the agent who arranges the transaction. If the bonds are purchased between interest dates, the purchase price includes accrued interest. And that's where bond purchases get a little tough. You got to figure out the accrued interest that you are buying with the bond. So here's how that interest would look. Investment bonds, 18,000, interest receivable, 135, and you're going credit cash. You are buying this interest. It's already, see, bonds, when they're issued, maybe it's January, and you don't buy them until March. Well, those bonds already have 2 months interest on them. Those bonds pay interest every 6 months to whoever holds the bond. It don't matter if you held it 1 month or 5, you get 6 months interest on that bond. All right, 18,000 times 6%. All right, times 45 over 360. Those bonds were 45 days old. We had to buy the interest already on the bond. Now, when we get the interest, which is 6% of 18,000 times 6 months, we get $540 interest. Now, revenue was only 405 because we bought 135 of that interest. Adjusted interest, of course, 5/12 of the 6 months interest is 450. When you receive that interest after doing an adjusted entry, you credit the interest receivable, and you only had interest revenue in January of $90. Here are some timelines. You can look at your book and figure these out. If the proceeds from the sale exceed the book value, cost, sure, then you got a gain. Sell them for less, you got a loss. Proceeds, 17,640. We paid 18. We got a loss of 360. You would be your entry. Debit the cash you received, debit the loss, and credit the investment, U.S. Treasury bonds. Okay. Okay. All right, the loss on the sale of bonds is reported as part of other income or loss. All right, it says to make those entries. Now, Alexander, if you were making this first entry up here, what would you debit? What would you debit for the 40,000?
Something dealing with a bond, difference between buying a bond.
Bond investment bonds, and you would debit interest receivable 500, your credit cash for 40,500. And then we're going to receive the first semi-annual interest payment, and then we're going to sell the bonds. Somebody multiply 30,000 times 102. Would that be 31,200?
30,000.
All right, 600. Yeah, 2 3s are 6. Well, it gets to stop. All right, here's the 3 entries: debit cash, debit interest receivable, debit investment, credit cash. And then we debit cash for the 2,000, credit to receivable for 500. You got to get rid of this debit interest receivable. Funding account in the first place. Go to, okay? Then a credit to interest receivable to get rid of it. Revenue is the other 1,500. And we sold the bonds. Interest revenue is 110, and we have that gain of 600, and we have investments of 30. So you got to get used to these bond entries in this chapter. Now you might buy common or preferred stock. Investor is whoever's buying the stock. Investee is the seller. All right, here's an important statement. This in turn determines the accounting method used to record the stock investment. Now, you may have a different entry if it's 0 to 20, a different entry if it's 21 to 50, possibly a different entry if it's 50 to 100. So, do we control any of that corporation? 4 or 5%, we have no control. When you get 20%, you got pretty good control, some control. Okay, now I think everybody has taken the second test. Less than 20%, here's what we use, the cost method. Between 20 and 50, we use the equity method. Now, that's the two main equity methods in the book, cost and equity. We don't have to worry too much about consolidation in this course. An intermediate or advanced, yes. All right, cost method is the first main method. We're going to look at entries for purchase of the stock, receipt of dividend, sell of stock. I think the purchase of the stock and sell of stock are going to be the same under both methods. It's the dividends that might cause a problem on the equity method. Now, what do we do with broker commissions? We bought 2,000 shares of stock at $49.90 plus a broker's commission. You add the broker's commission on. That's part of your cost. Together, that gives us $100,000. We debit investment and credit cash. Now, when we receive dividends, we debit cash and credit dividends revenue. That's it. 2 entries, investments, and dividends. That's the cost method. Of course, we can sell this investment and have a gain or loss. All right, here we have a gain on this stock of 65.90. We know that gains are credited. But that's the cost method. That's not too much to memorize. Now, if a person between 20 and 50, that's called the equity method. I want you to look at the entry. You debit investment and credit cash. Now you own how much interest in this corporation? How much interest do you own? 40%. Now this is where it changed. If a company declares a dividend, we own 40% of that dividend, but it's not dividend revenue. It will increase our investment. All right, they're going to pay out $105,000. We get 40% of that. So we debit investment and credit income. We didn't debit dividend revenue. So on the cost method, you credit dividend revenue. On the equity method, you credit income of Flanders Corporation. All right, now make yourself a T account. And how much do we have? And put investment in Flanders on the top of that T account. Make yourself a T account, at least a couple of you. Some of you are still on spring break, even though your body's here. All right. Now debit 350,000 in that ledger account, T account. Now debit 42,000 when we got part of the revenue. Now, if they pay us any of that in a dividend, you debit cash and credit investment. They gave out 45,000 and you got 40% of that 45,000. All right. Now in your T account, credit 18,000. Now, what is your balance in that T account? What is your balance? That's 350 plus 42 made 392. Subtract 18 leaves 374,000. That's how much you still have left. You got to know that if you sell it. You don't know how much you have investment. You don't know if you got a profit or a loss. And here's your answer, 374,000. And a gain is a debit and a loss is a credit. So we're going to sell this investment for 400,000. We have 374 in it, credit. We have a gain of 26. That's the equity method. Now, consolidation, we own more than 50%. This book's not going to make you do a whole lot with consolidation. We know we have parent companies and we have subsidiaries. Now, we know we have home office. Most of our major corporations have home offices somewhere. Ford Motor Company, General Motors, Chrysler, they have a home office somewhere. But how many subsidiaries do they have? How many branches do they have? They have factories maybe in 5 or 10 states. These securities are called trade securities. or available for sale or held to maturity. If I buy bonds, I'm probably gonna hold them to maturity. If I give somebody a long-term note. Well, now, stock and bonds, stock, probably, we got it available for sale or trade. Now, what we're doing here, we're gonna look at the fair value on the balance sheet. Now, this company, we paid 5,000. This company, we paid 11, and this company, we paid 8. You all know what Polaris makes, don't you? What?
Cameras?
Cameras? Polaris?
I'm not sure. I thought it was cameras.
I thought it's four-wheel. Is it four-wheel?
That's what it is. That's what it is.
What kind? That's four-wheel.
Yeah.
Those are out of business now, aren't they? You can still get a four-wheel cam?
Yeah, I have one.
I have one too.
Takes instant pictures?
Yeah.
Okay. I thought those were obsolete. All right, what does Armor Company make?
Yeah.
Armor? Now, this is not Armor at all. What do they make? I'm thinking it's oils and cooking oils and things. I'm thinking, I'm not sure. Now, this company, I have no idea. Does everybody know what they make? Maybe? I have no idea. All right. Now, the fair values went up, but here, the Maven Company, your value went down, and the fair value here, it's went up. So the total is 24, and the fair price is 25.3. Now, I don't agree and believe in going around making journal entries on your books just because the market price of stock goes up and down. But we need to know our values. All right. Here, we definitely, if we sold everything today, we would have $1,300 profit. So now we're going to put valuation allowance, $1,300, and we're going to put it on here unrealized gain because we're not selling. And on the balance sheet, we're putting cash, we're putting what we paid for our investment, and our valuation allowance of 13. We are showing it on the balance sheet that we're worth 25.3 instead of 24. You could have had a loss. If so, you would debit unrealized loss and credit valuation allowance. Available for sale securities, we handle about the same thing as trading securities. If these were available for sale, we still got that $1,300 gain. But we show it, valuation allowance, 13, unrealized gain on available for sale. So the entry's about the same. You'll notice the difference when you look at the book. And you'll notice the difference on the balance sheet. Here it says valuation allowance, 1,300. Here it says unrealized gain. I don't see a whole lot of difference. You got a page in your text somewhere and it gives you a rundown. Trade securities, available for sale securities, held to maturity securities. Balance sheet items. Now, we've had current assets. We've had property, plant, and equipment. Now we're going to add a third asset called investment on the balance sheet. Third asset called investment. Here's some major companies, the dividend yield that they're paying. Looks like Duke Energy is paying the best. No, Verizon Communications is paying the best dividend. So dividend yield formula, debit your dividend per share divided by your market price. Market price has to always be given. I'm not going to look at the appendix now for the time being. So what I want you to do is work for Thursday, the first 8 exercises in this chapter. Now, Cengage. I hope everybody, I'm going to look at that today. I hope everybody has got chapter 14 100% finished on Cengage. Anybody still lacking on chapter 14? Everybody's up to date. All right, now you need to read chapter 15. You need to start Cengage on 15. You need to work some exercise on 15. Folks, you've only got a half a term left. Let's make the best of it. I know some of you want to get out the principles and never see it counting again until you have to take manager on next fall. All right, let's call it a day.
Spent the weekend there.